the Fed is, even though they just had, their first 75 basis rate hike in a long time, they're still the furthest behind inflation they've ever been since 1951, since basically the end of the whole 1940s inflationary period. And so basically, they're basically further behind inflation that they have ever been since the last long-term debt cycle ended, right? So, and I think that's why historical analogs are important, because if anyone was using the 2000s mildly inflationary environment or the 1970s inflationary environment, they would have expected higher interest rates in response to that higher inflation. Whereas if I think you're looking at the amount of debt in the system and you're looking at kind of the low threshold of interest rates where things start to break, you would more readily expect that policymakers would have no choice but to have, basically have an inability to close that gap. And I think that that's what we're seeing playing out, and it's normal for macro people to be wrestling with this viewpoint, because it's not something that happened in their lifetimes. And so really you have to go back to history books, and you have to kind of look at bottlenecks in the system and start trying to judge what is the order of which things break. Because as you point out, if you go up to 5% interest rates, that sounds responsible. That's like, we should have positive real rates. I mean, if we have high inflation, we have to raise rates. That makes sense for a lot of people. But as you point out, that breaks basically everything. So, not just stock market going down, but housing market breaks. Probably the foreign sector has to rapidly start selling treasuries. Treasury market goes completely illiquid, like it did in March 2020. And then what do you do there, right? So it's like, it just, the whole system kind of seizes up. And I think that's a function of the fact that, for 40 years now, we've had lower and lower interest rates, all the way down to zero, and in some cases negative in some countries. And that's resulted in higher and higher debt relative to GDP. And that debt is only serviceable with low rates. And I think that is what defines a long-term debt cycle. That's why it's different than a normal deleveraging event, because there's so much debt in the system that if it ever delevers normally, the whole system breaks. And so given the choice between massive, bumpy deflationary collapse or printing money, that historically the result in printing money, which can take the form of holding interest rates below inflation for quite a long period of time. And so in the 1940s, for example, inflation averaged 6%, it spiked as high as 19%, and the Fed held rates at roughly 0%. And they basically just said, we're not going to default, so this is interest rates. And we're seeing that right now in Japan, where they're above their inflation target, but they're holding rates at zero, and they're capping their 10-year bond at 0.25% with yield curve control. They're basically printing money into an inflationary spike, because they're like, our public debt is 250% debt to GDP, so we're not going to raise rates to positive real levels anytime soon. And we're seeing a similar thing in Europe. They're basically saying, look, Italy's got 150% debt to GDP. They're not going to have positive real rates. They're basically, bondholders are going to default in one of two ways. If they raise rates, they're going to default nominally, right? So Italy's just going to be unable to service debt, or everyone's going to take a haircut, and Italy's not going to default nominally, but they're going to basically default in real terms. One of the things I've been analyzing is the question of, what does the Fed understand that they're not saying versus what do they not understand? That's actually kind of an interesting question, right? Because prior to this whole COVID fiasco and the money printing and the financial pressure and the inflation, BlackRock, with a former Fed official, released a report saying, in the next downturn, because debt's so high and because interest rates are so low, we're going to have to print a lot of money and probably do helicopter money, so probably fiscal stimulus combined with that. But that could be somewhat inflationary, so they're going to have to hold interest rates low for a period of time despite that. So you're going to have kind of coordination. And then the big challenge becomes how to not have inflation get too high and out of control. So like the whole roadmap was there. I mean, they saw basically everything. And there are a number of analysts like me and others that were, we had been reading things like that, and we've been doing our own kind of similar research and saying that's basically the problem. And so when it starts to play out in real time, central banks never come out and say, look, the sovereign debt's too high, so we just have to hold rates low and financially repress everything. I mean, they never just say that. They never say we have to inflate the debt away. So they have to use euphemisms. They have to kind of phrase it in different ways. And so the question then becomes, what do they know that they just have to phrase differently, or kind of push the can down the road and kind of mislead people, versus what do they actually that they honestly think that they can solve it, or that they that they think they're doing the right thing. And so, for a while, the Fed and other central banks were saying it's transitory, when a lot of us knew that it wasn't, or at least not nearly as transitory as they think it will be. And so I do think that the Fed and other central banks are facing a competence, kind of crisis here, where their tools have always been kind of lagging indicators, right? So they're not very good at forecasting. If you look at the Fed's track record of forecasting, basically what they do, they never predict a recession, because that, they're kind of an inherently political organization, right? So predicting a recession is kind of an inherently political statement in some ways. Even if it's not, it just comes off that way. So they never predict a recession. And what they do, basically, no matter if things are high or low, they kind of point back to everything's going to go back to 2%. That's all they do. They basically just draw a line from wherever it is now to 2% inflation and 2% GDP, real GDP growth, and 2.5% interest rates. And they just are always kind of going back and trying to point towards that medium, and they don't really have a good track record. And I think that that's all kind of being marked to market, or being kind of realized now, because now they're facing this kind of more endgame type of scenario, the super high debt level combined with inflation, which is just not something that their tools are well equipped to handle, and something that they contributed over decades to getting us here, that they don't really have the tools to get us out of. And so I do think that, in countries around the world, especially these developed markets that have these super high debt levels, so Europe, Japan, the United States, I wouldn't want their job, because it's an impossible job, and you either have to lie, or you either have to be stupid or kind of look stupid, and it's an inherently challenging environment to be in, right? So I think that they face a credibility crisis, and it's partially because they contributed to it, but it's also partially because their predecessors contributed to it, and that's just an inherently rough place to be in. I think that the model itself is old, right? I think that if you ask most people, are price controls a good thing? Should the government set prices of things? Most people say no. Whereas in the United States, we've had price controls on money since 1913, right? We control the price of money. Basically, a group of elders gets in a room every 6 weeks and determines what the price of money will be. And it doesn't matter where you are in the country. I mean, this is a country of 330 million people, 50 states, very different markets, and they kind of set the nationwide price. And then also, because we're the global reserve currency, this has international ramifications. And it's literally because a group of people in a room are determining that price. And so I just think that the model itself is kind of antiquated, and that as software eats the world, and as we kind of go through a somewhat inflationary crisis,